The market is beginning to shift, and so all the major forecasters are now updating their predictions for the remainder of 2022 and heading into 2023. 7 of the major forecasters are predicting an average of 11.3% appreciation for 2022, which is still above average appreciation for real estate. They're predicting anywhere between 9.3% all the way up to 16% for the 2022 market. So heading into 2023, the major economists are predicting more healthy and normal appreciation levels with an average of 2.2%. That is considered a normal appreciation range. Anywhere between that 2 to 5% is considered healthy. Of those economists, only one, that is Ivy Zelman, is predicting negative appreciation right now for 2023. And she's even coming in at modest levels of -4%. So why do we have one economist that's predicting negative appreciation right now? Well, there's a lot of negative news out there about housing right now, and maybe she's trying to capitalize on that to get some extra clicks to her website. But everybody else is coming in at positive ranges with 2.1 to 4.4% ranges for 2023. And this is a big thing too. 71% of the metros are predicted to have price appreciation next year, with only 29% declining, and that's just slight modest declines of 1 to 3%, according to Zillow's research that just came out. According to Bill McBride, an economist at Calculated Risk, prices are unlikely to crash for 3 reasons. Number 1 is solid underwriting. We've had one real estate crash in the last 100 years, and that was more of a financial crash, and that was due to poor underwriting. Anybody that could fog up a mirror could get a loan back in 2008. That's not the case right now. We have solid underwriting practices and solid borrowers that are taking on loans. Number 2 is prices tend to be sticky downwards unless there are forced sales. And so what that means is, if prices were to decline slightly, there's likely more buyers that are going to jump into the market. And it's only likely to crash if there's forced sales, and there's unlikely to be forced sales because there's so much equity in the market right now. Number 3 is inventory is still historically low. We have a 5.5 million home deficit in this country, and what is happening is, with higher interest rates, that is pushing down demand. More people are unable to afford new homes. But the second thing that is happening right now as well is it's also pushing down supply, because there are fewer sellers that are wanting to sell in this market, since they have perhaps a rate that starts with 2s or 3s, and they are unlikely to make that move when interest rates are starting in the 7% range right now. So there's fewer sellers, but there's also fewer buyers, which is averaging out that inventory right now. Another reason why we probably won't have a real estate crash anytime soon is that we have a very low loan to value ratio. It's actually the lowest it's been in almost 40 years, dating back to 1983. That loan to value ratio is sitting at 29.5%. So basically what that's saying is the amount of money that's borrowed versus the value of the property is at an extremely low level right now. There's actually $29 trillion worth of equity. Typically, when you have real estate crashes, you have very high loan to value ratios. That's just not the case this time. We also have record high equity. The average equity in this nation is at $320,000. So there's a lot of room for prices to potentially go down before sellers would actually have to be forced to sell. And that's very unlikely with low interest rates and high equity positions for homeowners at this point. Also, since pricing is a supply and a demand equation, with a lot of homeowners having interest rates in that 2 to 3% range, that is also going to continue to push down supply in this country. Now, the other thing that's affecting supply is that as we got to interest rates of 6, now into the 7% range, builders are now being cautious about bringing and building new supply into the economy. So that is further pushing down that supply imbalance that we already have in this country, and that's likely to push up the 5.5 million home deficit that we already have. So locally, what I think we're going to see over the next 12 months into 2023 is we're going to see more normal appreciation levels. I think we're going to see anywhere between 3 to 5% in the Huntsville market. What we will likely see also is fewer sales. There's likely going to be a 20% or so decline in the sales volume. And so with more buyers being pushed out of the market with higher interest rates, we're also going to have fewer sales. Those two things are likely going to cancel out and cause just normal appreciation rates in the Huntsville market in 2023. However, after 2023 and when interest rates begin to lower again, whether that be 2024 or beyond, we're likely going to see the exact same challenge that we've had over the last couple of years because we still have that supply imbalance. We have a 5.5 million home deficit. Builders are now not keeping up with demographics and building enough homes. And so as interest rates decrease, that demand is going to still be there, and we will likely see above elevated appreciation rates in the near future as well.